Yes, indeed. All right, we are live. My name is Jonathan Levin. I am a columnist with Bloomberg Opinion, and I'm here today to discuss Jobs Day with Catherine Edwards. She is a Bloomberg Opinion columnist as well, a labor economist and independent policy consultant. We also have John Lear, old friend who has helped us out with a number of these. John is chief economist at the decision intelligence firm Morning Consult. So he brings with him lots of interesting proprietary data and insights. Here's the deal. The market has been sort of on edge about jobs since the last jobs report a month ago showed an upward trajectory in the unemployment rate. There's a sense, for perhaps strange reasons, that the August jobs report, the one that we're going to get today, has a habit of coming in a bit weak, that there's maybe some excess seasonality in the numbers. And so for this confluence of reasons, I would say that Wall Street is a little bit more on edge than usual. Add to that the fact that yesterday's ADP Research Institute report also came in on the weak side. And so people are sort of bracing themselves for what we may see here in a few minutes. The consensus, as you can see on the screen, not actually so bad. The consensus in a survey of economists conducted by Bloomberg suggests that non-farm payrolls will add 165,000 jobs for the month of August. And there's also a view that unemployment rate, which sort of spooked people last month, may actually tick down a little bit to 4.2% from the 4.3%. Catherine Edwards, we're grateful to have you here. It's your first time doing one of these with us. You bring an interesting perspective that we don't often get here. Tell us, what is your sort of 30,000 foot view of the labor market today? Is this still a good labor market? Is it a labor market that's maybe good for some people and not others?
In the economy, trend matters as much as level, and level matters as much as trend, right? What direction are we going in and where are we standing? The unemployment rate right now is 4.3, and I can think of many economies in recent history in which we would have killed for a 4.3 unemployment rates. So it's helpful to remember and to anchor ourselves that this is still a very good unemployment rate for workers. We have not seen mass layoffs. We have not seen hires completely freeze up. We're not reading reports about graduates who have no jobs waiting for them and can't find anything, but it is moving in the wrong direction. And even from a strong base, moving in the wrong direction should be cause for concern. I'm hoping that Powell will see that they've done their job and it's time to ease up on consumers, because it's not clear to me how much more the economy can take before the labor market really tips.
Okay, John, where are you at on this question? Are we getting close to an inflection point here? Is it an inflection point that if we do hit it, monetary policy could maybe still save us from? What is your view?
I think I broadly agree with Catherine Ann. I would just maybe add, from the perspective of monetary policy, even by doing nothing, by holding rates constant right now, they are essentially tightening the stance of monetary policy as inflation falls. Now, the flip side there is that we have seen, positive real wage growth for quite some time now. And so I think that while we're concerned maybe about one margin, which is the number of people working, among those who are working, they're earning more. I am concerned right now that, the Fed, it's very difficult, right, for monetary policy to immediately produce a response in the labor market. It acts with long and variable lags. And so by the time we see this weakness, which I think all of us are looking for, it's likely going to be too late. I would agree that we haven't seen we haven't seen firings. We're seeing workers pull back from not looking for work as much. But it still feels like a pretty good time, all things considered, particularly when you appreciate that we're seeing that decrease in headline CPI too.
Yeah, well, we're just about 5 seconds out, so we'll know a bit more about what we're actually looking at here in in just a moment. So there you go. Your change in non-farm payrolls ends up coming in a little bit weaker than expected, plus 142,000. That's still an uptick from the weird last one that we got. I would underscore the fact that we have some downward revisions. So your 2-month payroll net revision ends up being negative 86,000. And then on the unemployment rate, you do tick down a little bit. For the real nerds out there, it'll be important to go out to a couple of digits, because it was sort of a light 4.3% last time. So as we're ticking down to 4.2%, maybe not that big of a move. I will just real quickly run over some of the wage statistics here. So a little bit of an acceleration in average hourly earnings month on month, seasonally adjusted. I will just remind people that this can be influenced by the makeup of jobs in the mix. So sometimes complicated to take too much signal from the headline number. Year on year, the average hourly earnings tick up to 3.8%. And one final point here, average weekly hours basically stable here. Yeah, it looks like ticking up a little bit from the prior report, but bang on with expectations, 34.3. I will real quickly take you over to the market reaction. It looks like, the even though we do get the unemployment rate tick down, gosh, I almost don't want to make too much about this knee-jerk reaction, because you see the swing up and then the swing down. So I almost don't want to define a narrative until we give this a few more minutes. But you could say that maybe there's an emphasis on the bearish story of the slight weakening in non-farm payrolls, those downward revisions over about 2 months. And so
one of the things, Jonathan, that jumps out is, I think
jump in there, John. Yeah.
This is consistent with sort of late stage business cycle responses from Wall Street, which is that it's actually quite difficult to interpret the data, right? Good is bad and bad is good sometimes. And I think that's what we're seeing right now, which is we don't really know what to make of this. Or investors, I should say, they're very skittish, because very slight changes in the data could mean pretty dramatic differences for monetary policy.
Yeah. What about you, Catherine? Any takeaways here?
I always refer to this kind of very special period in economic history, which we're fighting inflation, which does not happen that often, as the upside down. Like, it's so hard to interpret data, because if it's too good, that means something worse is coming. And if it's too bad, that means we've already overshot it. And this is a very much on par for an upside down jobs report of, like, it's not bad enough or good enough for people to know how to react. I will say, for my part in looking at this, I love low unemployment rates. I love that for American workers. I was never an economist who tell you that the unemployment rate has to hit 6 or has to hit 7 for inflation to come under control. And I don't make a lot of predictions, but I'm very glad to be hopefully proven right, because we do not need another recession on the heels of the last one. And I'm so glad to see unemployment stay stable.
Yeah. Anybody else here want to beat up on the Phillips curve a little bit, as we have seen inflation moderate for really 2 years pretty consistently, and unemployment stay near really extraordinarily low levels, all things considered, whatever you make of the trajectory here.
I don't know. Did you read Claudia Saum's note last night? I think she did a good job of laying out sort of the role that labor supply has played in sort of distorting some of the standard Phillips curve analysis. I think that's what we've seen. Certainly that's what we saw early on in the pandemic, with a really significant influx of supply. think most recently we've seen that as well. And some of that increase, a lot of the increase in the unemployment recently has been driven by increased labor supply, which is great. We're starting to see that stabilize right now. I think that's a sign that workers on the sidelines are starting to say, if you're not looking for work, now's not the time to just start looking for work. I think we see that similarly on the JOLTS data among employed workers too. So agree with the Phillips curve and all the challenges that it faces, but I also think some of the supply changes in the supply front are complicating the story.
Yeah.
Yeah, but the supply, I don't know, the supply story to me isn't very straightforward, because there's the supply that is easily enticed by a strong market and then cooled by a soft market to say, well, maybe now is not the best time to look for a job. But the US has incredible hurdles to labor force participation. We're at record high prime age labor force participation rates, and we still have a lot of people sidelined, even as wages are growing pretty quickly at the bottom, at least for certain periods. So I've always wondered, what the Phillips curve looks like in 10 years if we don't, actually put some policy towards easing labor supply. It's nice now because we don't want the bottom of the economy to drop out while we're fighting inflation. But, over a 10-year period, not having barriers to labor supply presents a significant problem. And that is one that we have truly not seen before. Inflation, it's been a couple decades, but no, having a shortage of workers to the degree that we could, if we don't get labor supply margins even higher, we're in uncharted territory.
Well, let me bring you a few more headlines here from our live blog. Just digging into the decomposition of the numbers a little bit here. We have Bloomberg's end of Curran reporting that the construction sector holding up, adding 34,000 jobs in the month. Construction, of course, complicated, includes things like infrastructure, but also critically residential, where we have recently seen mortgage rates tick down. Healthcare continues to be a big employer, and I continue to think that this is something that you would hope remain somewhat immune to whatever is happening cyclically, because the healthcare sector really just does so badly need these nurses and other professionals there. We heard the terrible stories of shortages during the pandemic and people who left the workforce, and it's just been such a persistent challenge to get qualified people into those jobs. Turning to the Fed a little bit, of course, I'll remind everybody that we have a Fed meeting coming up, and Fed Chair Jerome Powell has all but told us that we are going to start reducing rates at this month's meeting. But the magnitude of the first move is still a little bit up in the air. We have Bloomberg Intelligence's chief U.S. interest rate strategist, Ira Jersey, commenting in our live blog. With the downward revisions, the market may not completely price out the chance of a 50 basis point cut at the next Fed meeting, even with wages remaining solid. Next week's inflation data will now be the final determinant. John Lear, do you agree with that? Where do you stand on Fed policy?
I agree. I think I'm moving. I previously thought 50 basis points was sort of outrageous, and I increasingly think it's in the realm of possibility. I would agree. I definitely agree, and I strongly sort of support Ira's point that as we get these numbers that are sometimes not conclusive, it all turns to the next data point. And so again, we saw some of that volatility around this print. I think the CPI next week we'll see even more sort of hyper focus there. My biggest point would be, the trend. The trend is the trend. I think we know that pretty clearly, right? That inflation is falling, even without doing anything. Monetary policy is tightening. It's going to take some time to affect the economy, so we need to lower interest rates. That doesn't mean that we're taking our foot off the brakes per se. It just means that we're sort of slowing the rate at which we're stopping. I'm more inclined, I guess, from just sort of from a temperamental perspective, to go with 25 basis points right now. I think there still is a lot of uncertainty, and I like the optionality down the road, but that's maybe more of a personal preference than an objective function from the Fed.
Okay. Let's real quickly work through a little bit of a decomposition together, try and understand what is going on with unemployment. Because people make a very big deal, rightly so, about the trend in the unemployment rate, and there's an observation that it tends to be sort of inertial, or once it gets going in a certain direction, it tends to keep moving that way. I tend to think it matters a lot what is actually moving unemployment. So I wanted to dig in there a little bit. As you see here, so we do see headline U3 unemployment ticking down to 4.2% from 4.3%. Where is that coming from? Job leavers, fairly stable. Re-entrants, fairly stable. We do see a little bit of an uptick in new entrants to the labor market, moving this. Permanent job losers, again, pretty stable in their contribution to this. This is not a story where all of a sudden, out of the blue, employers are starting to lay people off at a pace that's much quicker than what we had been experiencing. I will point out last month's report, when we were surprised by the uptick in unemployment, a lot of the story was temporary layoffs, and people sort of did some chin stroking about whether or not this was a meaningful signal or not. Again, you see a big jump in the contribution from folks on temporary layoff. That in our decomposition up here, is that an aqua? Do we have color
Yeah.
specialists? That's the aqua up here. So that took a big step up in the July report. It's now stepping back down in August. It's purely conjecture, but that might be a function of a lot of things. Certain auto plants tend to shut down temporarily over the summer months, do some retooling and things of that nature. Could have been related. But, all told, we're not seeing a lot of movement here. We're not seeing a burst of permanent job losers. And in fact, we're seeing a little bit of a reversal of that temporary layoffs situation. Does this decomposition make anybody feel any better? Catherine Ann?
They're all... I don't know if it made me feel better, because I didn't feel that bad.
I'm glad to hear that.
Yeah, y'all, don't worry about me, everybody. I'm doing great. This is very much where we expect to see these numbers. The share of the unemployed, you can look at the distribution like this, what percentage of the unemployed comes from what places and from kind of what parts, and honestly, they're very stable over time. And even the small movements, because you're looking at a fraction of a fraction, that they could really belie more statistical error than like real big movement in the labor market. There are some leading indicators buried in here that I tend to look for, but I just don't see any. Okay. I think this is what the unemployment rate looks like in a strong economy and in a strong labor market. And I think that typically when we're worried about a recession, we're not used to looking at an unemployment rate this good.
Yeah. Yeah, for sure. And just real quickly to run through a few other things on here. I will point out that you know a lot of the contribution to U3 unemployment coming from under 25s. You do actually see that tick up a little bit. Now, I actually let me toggle over here. Um, yeah, you among 25 to 34, you see the contribution tick down a little bit. Hard to take too much signal from what we're seeing here. Going over to education, we do see the contribution ticking down a little bit from high school graduates, no college degree, and then a little bit more unemployment contribution coming from those with a bachelor's degree and higher. But again, these are relatively small numbers coming from the household survey. We're going month to month here. I'm not going to get too worked up about the details, which could change next month.
Can I prognosticate a little bit?
Prognosticate away, please. That's what you're here for.
Hyper speculative.
Yeah,
I don't know if you saw. So the IMF came out with a report earlier this week, and I think it's something sort of similar to what I've been saying for a while, which is I think if you go back to that last chart by education.
Yeah,
this is one I think we should watch really closely, particularly given this sort of work from home dynamic. And so I think what we'll see, and what we've seen a little bit and we'll continue to see, is a much less rigid labor market for those bachelor's degree and higher contributors, because they're able to work remotely, because they're able to sort of stay in their house and stay in Southern California and work for a large coffee conglomerate in the northern part of the northwestern part of the U.S. And I think that's a phenomenon that will be sort of a lasting structural change. And for me, when I look at this data, I'm really thinking about how does the work from home phenomenon change the sort of analytic framework that we should apply to the labor data, because I do think it's going to be, like I said, sort of a structural shift.
But is that above the surface or beneath the surface? Is it, in these numbers, we'd have to assume that they're getting, that a different share of them are employed, or a different share of them are looking. So I think I could see that happening if you have, more holdouts of people who have a little bit more command and power in the labor market, staying unemployed for longer until they get that remote job because it's seen as a better one and they don't want to move somewhere. And I could also see it increasing labor force participation amongst certain segments of the college educated population that don't like commuting in, people with a disability, people with a long-term illness, people with a disability or long-term illness of their partner, or women right after they give birth. So it could change on those margins. But the problem I have, or I guess the reason why I don't know what it'll look like or have a strong intuition about it is that these were already people who have a lot of command and power in the labor market, and it's not clear to me how much of a difference in quality they'll get. Like these were already people who we expected to kind of land on their feet. So I'm with you that the structure is changing, but I wonder how much we'll see in the data versus how much is just kind of shifts below the surface.
Yeah, maybe the marginal impact is low because they already had a high level of sort of bargaining power.
But it's worth saying that marginal impact that we see in numbers on a screen as we look at, trying to think of what the Fed and markets will do, it's an enormous impact in people's lives and their ability to work in a way that suits them, that, increases job satisfaction, increases productivity. It is still a really good policy that a lot of companies don't pursue, but it shouldn't have to show up in aggregate national data for it to be a good idea.
Yeah. I think also, just as I think about your question earlier, John, about sort of the haves and have-nots of the labor market. This to me seems like a structural shift that is likely to exacerbate some of those pre-existing inequities.
Absolutely. Yeah. I mean, this is this is probably one of the biggest, meaningful imprints of the K-shaped recovery. I mean, we had talked about it for so long, and then wages grew at the bottom. We're like, oh, maybe it's not K-shaped, but K doesn't just apply to the wages. It also applies to working conditions. It also applies to kind of satisfaction and productivity. And you've got a group at the top that has always earned more, whose wages have always grown faster, and now they're able to command the amenities on the job that the bottoms just has almost no chance for. So I think it's a absolutely indicative of that K. Maybe not the way we thought we would see it, but probably the way a lot of workers live it.
Hmm. Well, I want to take that as as an opportunity to switch over to macro grab bag here. You know, we spend a lot of time, talking about cyclical stuff, about inflection points, about month to month wiggles in data on this one. But glad to have Catherine on this month, who is great at addressing these big picture sort of questions, hairy questions for policy and so forth. She's got a great column out today on the challenges for parents. And I wanted to get into a little bit of that. I think your point, the sort of money quote in that one, in that column today, Catherine, is in the grand tradition of being right and wrong at the same time. Maybe prior generations of parents did have it harder in juggling all that they juggle: life, career, raising kids. But there's nothing to gain by withholding help to today's parents. You're out there saying it is tough being a parent in today's economy, today's labor market, and so forth. And you've got this great chart in there. And I wanted to give you the stage to talk about today's column a little bit.
Thanks, John. I think that this is probably something a lot of people have experienced in their workplace, where you want policy to evolve. There is something that policy can fix. You want to change to paid leave policy, you want to change to sick days, or change to working from home. And sometimes what's standing in the way is, not to throw shade at anybody, but someone who basically never had those things and don't understand why you need them. And there's this reluctance to change things in your wake. If you made it, they can. And you hear this a lot when it comes to policies to support working parents, of like, I don't know why you need a breastfeeding room. I had to do it in the staircase. Like, I don't know why you need paid family leave. I made it work out and left my baby at home after 4 weeks. Like there's this, I had it hard, so you don't need help. And what I wanted to write about in this column was not that that's wrong, but that it just doesn't get us anywhere. That there's so much to gain from having policies that support parents as workers, and that understand from a labor market's perspective that everybody who contributes to our economy, that everybody who is part of this, grand scheme of productivity that keeps us all moving, they have other demands on their time. And you can either ignore that, or you can meet it where it is to make it as easy as for those workers as possible to meet those demands and meet your productivity needs. So I appreciate you putting this up, because for whoever needs the badge of had it the hardest, get it. Like, it's yours. The economic question is, are we limiting ourselves by not giving more structural support to people who have children in order for them to succeed in the labor market? Are we clipping our own wings because we're telling certain people, you don't deserve help because I didn't get it? That is the mistake. If you need to be harder, if you need it to be hardest for you, you can take it. But we're leaving gains on the table by not helping parents when they're asking for it and when they could benefit from it.
Okay, and we were talking about work from home here. How does the work from home dynamic change things for working parents, if at all, or does it change things for certain parents but maybe not for others?
It certainly comes down to preferences, but in a lot of European countries, maybe even people who are watching could testify to this, there are rights to request part-time and flexible arrangements in order to maintain labor force attachment through a period of just really high intensity parenting. I mean, it's not the same to have a 1-year-old and an 11-year-old. They require very different demands on your time and attention. So in kind of some European countries, you can request the right to go part-time at your employer. You can request the right to have more flexible arrangements. And, economists who have studied labor force participation and who have seen the US's women's labor force participation at one point be the standard bearer, near the top, and just absolutely fall every year relative to our peers, they have pointed out that one of the biggest missing pieces of women's labor force participation in the US is part-time work. Part-time work that parents can, they want to support their kids, but they want to earn money from their family. We don't have high-wage part-time work in the US. It's either, shifts work that has very little dignity, control, or pay, or it's multi-level marketing schemes. We haven't made this option available to mothers or fathers who want to take advantage of it. But it's a hole in our labor market, and one that could fill, a lot of labor supply, productivity. And I guess for you, maybe skeptical out there of like, I don't know why I need to make special rules just to let mothers work more. I always try to put it in a fiscal perspective of, you might be spending a little bit more on workers for 3 years to keep them attached, but the risk is that you lose 30 years of earnings and income tax revenue for someone who will never work again. And this period of maintaining labor force attachment is one that we've typically met with a cold shoulder, but there's a lot to lose by not helping people stay on the job. So as even for those of you who are not moved by the plight of children or their parents, should think about how we want our labor market to function going forward.
Yeah,
Can I add, as a recent parent, I just can't endorse that enough. But also, structurally, I think we face some very serious labor supply issues. Fertility rates in the U.S. are not great. In Europe, they're really abysmal. And so I think even if we were to extend that out, let's say over the next 30 to 40 years, we need people in the US to be having kids, and immigration can solve some of that problem, but not all of it. There's got to be a pretty concerted pro-parent agenda that is going to drive labor supply in the long run.
Yeah, I mean, if women's labor force participation was 5 points higher, I mean, we'd have millions of more workers. It would completely change. I mean, I think there's the National Association of Manufacturers did a report that they just needed like 1 million more women, and they'd never have a labor shortage. It's some kind of like startling statistic. Don't quote me on that one because I don't have it in front of me. But we have a amount of untapped workers who find the labor market too rough to do while parenting. I always remain optimistic about, the policy expectations around paid family leave on a federal level, around childcare on a federal level, around finally having paid sick days for the quarter of American workers who don't get a paid day off when they're sick or when their kid is sick, that at some point the labor market is going to force Congress's hand. Our long-term labor force participation projections are not meeting what they need to meet. And when we have to go find workers, the biggest pool is women.
Yeah, well, a very important point, both for the macro and and for households that need help. Absolutely. I want to continue on with macro grab bag here. I get I get some great data from John and his team that helps us think in different ways about what's going on in this labor market. And I just wanted to put up this chart that I got.
I needed you to change from that other chart. I was starting to get some anxiety about having to child's tuition and trying to funnel money to 520.
Oh, it's not, John. It's not good.
I don't want to worry you too much.
That giant sucking sound is actually all the money leaving your bank account when your kid gets in childcare.
I hear you, John, as the father of two. So here's an interesting breakdown that your team pulls together through your proprietary data, John, and you'll jump in and tell me if I'm wrong, but what I'm seeing here is that job search activity, people who are actively on the hunt, or they say they're on the hunt, still quite elevated among among those making less than 50,000, still pretty elevated among those making 50 to 99. Job search activity seems to be dropping off quite meaningfully. Maybe you'd say normalizing. I don't know. I'll let you pick the descriptive term here, but a rather big drop off for those higher income households, but still pretty high search activity for everybody else. Is that how you're reading this chart, John?
Yeah, that's pretty close. I mean, so we talk to 6,000 people in the U.S. per day. Roughly 3,500 of them are employed and say they've worked for pay or profit in the last week. And among that group, we see we also ask them then, if they actively applied for a job, and we see that job application activity, job search activity has dramatically fallen or continues to fall for that higher income group. I think this is, to some extent, this is a sign of how the higher income group does tend to follow the stock market more. They follow those sort of financial news stories more. Whether or not they impact their own personal job prospects is unclear, but clearly they have this signal that they get from following financial news in the stock market that things are harder than they were previously. I think to some extent also this reflects again sort of some of the sectoral and skills discrepancies in the demand for labor right now. And so service sector jobs and service sector employers are still looking for workers. And I think when you think about the extent to which their finances are pinched as well for the folks who are making under $50,000 a year, they have to look for other jobs. And we see it at the folks in retail and the leisure and hospitality sector. They are just structurally more likely to be looking for and actively applying for new jobs. There's more churn there, and if folks pay them a higher wage, they're going to jump ship. And so I think that's some of what we're seeing right now. But as we look at the JOLTS data earlier, again, the JOLTS data is from the prior month, so this just gives us a little bit more of an updated read that through Saturday this past week, that higher income group continues to pull back in terms of their job search activity.
Okay. All right. Well, folks, I want to wrap up here, but just to put a pin in this. So we have 142,000 net increase in your non-farm payrolls in the United States of America. Unemployment rate actually ticking down to 4.2%. So a little bit of improvement there. I wouldn't say that will completely alleviate some of the jitters out there. Just to give you a sense of how sort of confused this market is as to how to take this report. We saw a meaningful drop in yields, very meaningful off the back of the report. Intraday, that move has basically completely reversed itself. But you have your yield on the 10-year Treasury note sitting at 3.71%, which, if you look at where we were some months ago, is still down quite a bit. So we'll see how this shakes out during the rest of the day. I want to thank very much John Lear from Morning Consult for joining. Thank you also to Catherine Ann Edwards for joining. Check out her column on the Bloomberg Terminal and the website today. My name is Jonathan Levin. I'm a columnist for Bloomberg Opinion, and please join us again for the next one.